Hello everyone, I'm Miles. Today we're going to thoroughly understand capitalized assets through 4 practical accounting problems, so that in the future, when we read financial statements, we won't rely on intuition, but on numbers and logic. Why are capitalized assets so important? Capitalized assets, such as the data centers that major tech companies are working hard to build in 2025, essentially represent cash that has actually flowed out of the company, but is temporarily parked on the balance sheet. In the future, this cash will gradually flow into the income statement through the following ways: scheduled depreciation of tangible assets, scheduled amortization of intangible assets, and unscheduled impairment losses when expectations fail. It is precisely this gap between the timing of cash outflows and the timing of expense recognition that forms the core driving force behind changes in profit tax burdens and cash flow. It's important to emphasize here that not all long-term assets are subject to depreciation or amortization. Assets with indefinite useful lives, such as land, goodwill, and certain trademarks, are capitalized but are never depreciated. Therefore, today we will focus only on capitalized assets with a limited useful life, that is, those assets that are depreciated, amortized, and may be subject to impairment. First question: partial annual depreciation profit is shaped by time. The equipment cost is $360,000 with a residual value of $60,000. Depreciation method straight line over 6 years. Annual depreciation is $360,000 minus $60,000 divided by 6, which equals $50,000. Equipment purchased April 1st, used only 9 months that year. So $50,000 times 9 divided by 12 equals $37,500. Depreciation expense on the income statement reduced by $37,500. With a 20% tax rate, the tax shield adds $7,500, resulting in a net profit of negative $30,000. On the cash flow statement, add $37,500 to operating cash flow, as non-cash expenses are added back. Investment cash outflow is negative $360,000. The key point is that the cash flows out on the very first day, while the profit is allowed to be recognized gradually over time. Second question: the timing of recognizing amortization and impairment in accounting. The capitalized cost of the software is $800,000 with an amortization period of 8 years. The annual amortization is $800,000 divided by 8, which equals $100,000. After 3 years, the accumulated amortization is $300,000, so the book value is $800,000 minus $300,000, which equals $500,000. Due to a major technological disruption, the current market value of the software has suddenly dropped to $350,000, which is also its recoverable amount. Therefore, there is an impairment loss of $500,000 minus $350,000, which equals $150,000. In the third year's income statement, amortization reduces by $100,000, impairment reduces by $150,000, the pre-tax impact is negative $250,000, the tax shield adds $50,000, and the net profit is negative $200,000. Therefore, in the cash flow statement, operating cash flow CFO increases by $250,000, all of which is added back as non-cash items. Obviously, impairment is not a cash event, but rather a quantified admission by management of a failed judgment about the future. Third question: the profit from selling assets may just be an illusion of the past. The equipment cost is $500,000, with a depreciation period of 10 years using the straight line method, so annual depreciation is $50,000. After 6 years, accumulated depreciation is $50,000 times 6, which equals $300,000. The book value is $200,000, and the sale price is $260,000. The disposal gain is $260,000 minus $200,000, which equals $60,000. On the income statement, the disposal gain adds $60,000, taxes decrease by $12,000, and net profit increases by $48,000. On the cash flow statement, operating cash flow is reduced by $60,000 to exclude the book gain, and investing cash flow increases by $260,000. So from an investment banking perspective, profit may be exaggerated or distorted, while cash only reflects the facts. Question 4. Are depreciation and impairment really the same in terms of cash flow? Company A has depreciation of $80,000, Company B impairment of $240,000, tax rate 20%. Net profit: A, negative $80,000 plus $16,000 equals negative $64,000, B, negative $240,000 plus $48,000 equals negative $192,000. Operating cash flow: A, negative $64,000 plus $80,000 equals positive $16,000, B, negative $192,000 plus $240,000 equals positive $48,000. The two are not the same, and there's only one reason: the tax shield is a real cash flow. Tax shield amount: for A, $16,000, for B, $48,000. Because if the tax rate were 0 and there was no tax shield, then the change in operating cash flow for both would be 0. This is exactly why banks prefer to analyze EBITDA, while valuation models must treat tax factors separately and seriously. At the end of the day, depreciation, amortization, and impairment have never been just accounting rules themselves, but rather ways for companies to price their judgments about time and their mistakes. In reality, what we're trying to understand is how companies pay the price for being overly optimistic, and when and in what form that cost will show up. True understanding doesn't just come from the concepts themselves, but from that moment when you've calculated deeply enough and finally realize what's really going on. Numbers never lie, it's just that people often avoid facing the truths they reveal.